In this video, I'm going to show you the UK stocks that I bought this week in the market volatility. I'm also going to show you the top rises and also the top fallers. And I'm also going to show you the share tip of the week. And if you like the format, please drop me one of these to support the series. According to Google Finance, the FTSE 100 is up by 5.9%. The FTSE 250 is up by 4.14%. And the S&P 500 is up by 6.5%. The stock market has risen quite sharply this week, as I suspect it had been priced down with a combination of second wave of the virus fears, which then went to a UK national lockdown, which had relieved some of those fears, and furthermore the US elections, the uncertainty around them. But now that there's an answer to it, I feel more certain, more confident in the markets, and I guess I would replicate what general investors thinking. And you know what? Biden in the office doesn't matter too much to me, and I'm happy. I'm not going to sell, for instance. However, my portfolio is up by 6.63%, which marks the second consecutive week that I am outperforming the markets. But this is understandable that I had outperformed the markets this week simply because I have a higher beta volatility of my portfolio. The higher your beta volatility, it basically means that if the market drops by 10%, your portfolio will likely drop by more than that. I think my beta volatility is currently around 1.25, which means if the market drops by 10%, my portfolio is likely to drop by around 12.5%. But this isn't an exact metric, it's not going to tell me each and every time, but rather this is a rough estimate of how much the volatility is in my portfolio. But it does also mean that in upswings, if it raises, the market rises by 10%, my portfolio is more likely to rise by 12.5%. I'd just like to take some time to say thank you to the people that are regularly responding in the community and answering the polls. We are nearly 2,000 members of this community, and as of recording this video, we're at 1,991 subscribers. So likely by the time this is uploaded, it's going to be very close. So I appreciate all of your support, and I very much thank you for answering the most recent poll, which was in Saturday evening, about the repetitiveness of this portfolio update and what to approach in the top topics of the week. And starting the top topic of the weeks, we are starting with Ocado, the largest technology firm in the FTSE 100. They lifted their forecast for full-year profits, effectively meaning that 2 months ago, they had forecasted that for the full year, they were going to be making or expecting the underlying profits to be £40 million. However, since then, due to the national lockdown, they have now risen this as the pandemic has meant that more people are actually shopping online, has meant that they'd risen this forecast from 40 to 60 million pounds. This had lifted shares in trading, and there were a few people in the comments that had said Ocado is a good option right now, it is so low. Ocado's shares are up 13.31% as of this week, and if they continue their growth, which had happened in the last lockdown, this could be a truly incredible growth stock. AstraZeneca, a biopharmaceutical company listed in the FTSE 100, actually, in fact, I think it literally is the FTSE 100, seeing as it is the largest entity in the FTSE 100, had actually announced that they expect their pandemic vaccine trials to be completed at the end of this year. But what is interesting about this is that they plan to provide these vaccines at a no profit margin. Effectively, they've said that, yeah, they will add 20% marked up to it so they can ensure they are not loss making, but they're effectively doing it not for profit. Now, I know this isn't news, but what I'm interested in is that it's been suggested that from as early as July next year, they could declare that we are no longer in a pandemic and therefore change their pricing plans and perhaps increase the price of these vaccines. Now, if you know more than this, then please drop a comment down below, as I'm very curious. But this can provide them an opportunity as a business, but also could be quite devastating. I suspect they will have to get a lot of legal support, and it likely wouldn't be very good if they did rise the prices, but they have that option in the catalogue. For now, their revenues had risen by 3%, but their earnings per share had actually dropped by 4%. The third topic of the week has not been discussed anywhere else before except from last week, and I spoke about this last week in a post, and that is because as the second national lockdown is here, I completely understand that with the second national lockdown that this can take a toll on the mental health of individuals in our community. I certainly understand the prospects of isolation, perhaps loneliness, and so it does make sense to me that people may be struggling at this time, and so I had the idea to create the Discord group. This Discord group is focused on personal finance, investing, and financial independence, retiring early goals, but I hope that it allows our community to build and grow together, much like the channel has had success recently. Although this Discord group I feel that will be bigger than myself. I don't want to say that I am this amazing person. Look at me. Oh, I've got nearly 2,000 subscribers. Look, please just ignore that. What I'm trying to say is that this Discord group is designed to not be focused primarily on me, but rather that we could build our own community, that we can all chat, maybe make new friends and learn more and develop. Therefore, this Discord group, if you'd like to join it, it is going to be completely free. I'm going to place the link in the description down below and you can sign up. From 11 AM till 1 PM, I'm going to be active in the Discord today, so feel free to join, say hello, and I will be there interacting in the community. Quite a change this week as I've actually had multiple double-digit rises in the portfolio, which may be surprising as for the last 2 weeks prior, I was saying that there wasn't many rises, but rather the ones that had lost the least. Anyway, this week, Games Workshop was my top performer with an incredible rally of 10.53%. At the start of the week, they were significantly priced down by the fears of the second national lockdown and the impact on their retail stores, especially because they are not essential and therefore they would be shut and losing a significant revenue stream. However, later in the week, they had released a trading update, which effectively had said that, you know what, during this period, we actually forecast or predict that our profits are going to be higher than they were this time last year, despite the pandemic. And this is because of the resilience of their online retailing segment. Furthermore, they had predicted that this would be increased by £22 million, which, without knowing the scale, that could be good, it could be bad. When you compare it to last year, they had made £58 million. However, they are anticipating a figure of around £80 million at least in this time period, which is truly incredible considering we are in the middle of a pandemic, and that's why shares have risen quite dramatically. I'd actually bought a share of Games Workshop, which is quite surprising as I had been kind of focusing on other stocks, but I saw that there was an opportunity. I bought exactly £100 per share, added that to the portfolio, and now they're sitting at around £114 per share, which is quite incredible growth around a 5-day period. And as I say, I buy it on every weakness, and it's important not to get caught in the trap of not wanting to average up because you don't want to increase your cost basis, but I'm hoping that over the long term that I'll be rewarded with more equity in Games Workshop despite perhaps a higher short to medium term cost basis. Maybe unsurprisingly is my underperformer of the week, and once more it's SoftCare. SoftCare have not been doing so well since their last trading update, and they have suffered from a lack of investor sentiment. Although I don't think that's just justified this week as they had gone through their ex-dividend date. Typically on the ex-dividend date, the share price subtracts the dividend from it as investors try to trade using algorithms, I believe, to therefore get some value whilst also getting that dividend. What I suspect is because the dividend is roughly 24 pence or 24.2 pence, that this means that since the share price is around 1100 pence, that it is quite a significant amount, although it still didn't follow the markets that well. I'm not concerned in any way about the short-term lowering of investor sentiment with SoftCare, and I strongly believe that this may take multiple financial updates before this sentiment changes and they become more of a keen growth stock that many people are interested in the UK. Regardless, I'm going to take this opportunity to top up my position. And whilst this week I only had bought 2 more shares and bringing my total count to 109 shares, it's still quite a significant amount, and they only take up 8.6% of the portfolio. Ideally, this will be 12.5%, increasing my exposure to the UK domestic economy and therefore really allowing me to benefit from the bullishness I have and the recovery of our economy. And that's because I feel in the future the FTSE 100 will likely continue to underperform, at least comparing it to the FTSE 250, as they are completely exposed to the UK, or a majority of them are, and it therefore means if the pound rises, they've got more spending power across so they can import goods for a cheaper price. And if you sign up to Trading 212 using my link in the description down below, you can deposit £1 and get a free share worth up to £100. So if you're looking to get started investing, click that link down below. I'd also like to mention my holding with Ashtead Group, and that stock has performed very well in the last week, only just trailing Games Workshop by around 0.2%. Obviously, they're very heavily tied to the US economy, and so it does make a lot of sense as to why they would be rising, especially because now there's more certainty with the elections. Whilst I hold 45 shares, currently I have an allocation of around 9.7%. I'm actually looking to downgrade this position. It's by far my best performing FTSE 100 stock, And what I'm going to be doing is actually lowering my overall exposure to the FTSE 100, which means my target allocations for the stocks, Ashtead Group, Halma, London Stock Exchange, I'm looking to have around a 7.5% allocation to each of them, therefore giving me a small amount to the FTSE 100 in what I would consider the best stocks listed in the FTSE 100 in my knowledge, and therefore focus more on AIM listed equities and FTSE 250 stocks. I like the idea of investing further into mid caps and small caps and feel that there's a little bit more growth potential there, and then what I can do is get into a company earlier, and then as it gets bigger and into the FTSE 100 I'll continue holding, but at a much better cost basis. Lastly, Boohoo had kept up with the markets this week, although there's no massive news or information on it. Like the Boohoo investors, I'm very much still waiting on the news of an auditor or not. I'm not concerned if this goes either way. If they find an auditor, it's likely the share price is going to rise back up. Maybe not to where it was, but it's going to have a boost in investor sentiment, that's for sure. If they don't find an auditor, I'm not that concerned. I'm going to be speculating here, but this could mean the shares could be suspended, and that's really not a concern to me because I'm a long-term investor. Sure, this would be very terrible if you're a short-term investor or a trader, and that means, yeah, you're going to be stuck, you can't leave it, or even if you're a shorter. But if this meant that these shares got suspended perhaps the next year, maybe two, it allows me to focus elsewhere, and a lot of my attention was diverted into Boohoo, and if they give the time to suspend their shares, which they are able to do as an AIM listed equity, take the time to really address the media, fix their governance issues and stop the market manipulation, then this could prove beneficial to those more interested in holding longer term. And if burning out shorters is their goal, then so be it. Then again, I am completely speculating, and I think it is very unlikely in my own opinion, but I think it is best to expect the worst and hope for the best. As you can probably tell, I like my recovery plays. After all, I invested in Boohoo in the middle of the crisis. Furthermore, when I like to look at share tips of the week, recovery plays are just more interesting to me, simply because I think a lot of my stocks at the moment are trading at all-time highs, and they're seen as more boring. They don't have as much growth potential, or at least they don't look like they do, simply because they're just at all-time highs, so they can't go up as much. Regardless, this means I take more of an interest to stocks that have been a bit more battered, beaten up, and that's what I like to suggest. So the one I have for this week is a high value recovery play, but you will be battling against a lot of investor sentiment, which has been significantly lowered over the last 5 years or so. But this has considerable short to medium term risk in terms of capital appreciation, and you could very well lose money on this investment. This stock is what I would consider to be a conglomerate, although not on a large scale like you would associate many of them to be, but rather this has two industries that are very different and interestingly partnered together. Usually I would very much oppose these stocks because whilst yes, they have all these different businesses, they're well diversified, how can they effectively and efficiently manage each individual industry and gain significant returns from them, right? They'd have to align somehow, and it just seems unrealistic to me that they could grow all of these at the optimum pace compared to a business that is completely focusing on one industry. Regardless, this is one with two different industries, and they have a food outlet and they also have a retail outlet. And this company has the advantage of being in a very defensive industry, but also one with some growth potential. And although the odds are currently against them with the pandemic, this stock is named Associated British Foods. And believe it or not, if you didn't know already, they actually own Primark. And if you don't know what Primark are, maybe you're a viewer that's not in the UK, Primark are a fast fashion retail store that provides very cheap clothing. And why would I suggest a company that's in the fast fashion industry, especially if I'm invested in Boohoo, which would be considered to be their competitor? Well, this is because I still think there's a lot of room for growth in the UK industry, and I don't think Primark's going away anywhere soon. Right now, they are significantly priced down. This is because they're going to close their stores, or they already have due to the national lockdown. They may be missing out on this Christmas period, which would be vital for them. But Then again, they also have this food outlet, which their revenue is very diversified. This gives you that defensive potential, and their food revenue streams, such as sugar, for example, are all very resilient. Of course, they're not getting double-digit growth on their revenue, but it is resilient. This means that this is that more defensive sector of it, whilst then they can have the more growth of it towards Primark. And recently they had been developing their online retailing outlet, and a few years ago I'm pretty sure this didn't exist and you had to go in store to get products from Primark. But nowadays there is an online option, so they have the opportunity to start building this up, and hopefully the pandemic pushes them in that direction to an idea where they will actually really start putting more towards it. But I still think there is an advantage to these retail stores, and that if you feel that the pandemic will be dissipating in the medium to short term, then it could be a good time to invest, especially because they are significantly priced down. And this is because ABF are in a fantastic financial position. They're reducing their debt to equity ratio, which is now around 5%, and have a cash position of £2 billion. They have got enough on the sheet. Of course, yes, they have suspended their dividend. I think that is justified. They've just got to keep their stores, just keep the upkeep going, and then once they can come back, they can slowly build upon it. Of course, this isn't going to be a stock of high growth potential in this industry like ASOS or Boohoo, but what they give you is a very defensive stock that gives you diversification into multiple sectors, but also that growth potential of that fast fashion industry. I don't think this is a growth stock, as I've mentioned, but rather I think this is a good dividend opportunity. And if I look at the track record in the last 20 years, it is truly incredible. Dividend growth wasn't exactly the fastest, but it was reliable. And obviously the pandemic has shaken that up, but I don't suspect there'll be many more pandemics to be coming in the next few decades, and I think we will be much more prepared for them. So I feel that this could be a good opportunity to purchase associated British foods, especially considering they are significantly priced down. And if you go and hold them for the medium to longer term, then you may benefit from adding this more defensive, reliable dividend income stock to your portfolio, but also have maybe a little bit more growth potential than more of your standard dividend stock. I will be doing a stock analysis on Rolls-Royce on Thursday, and if you're interested in my Tesco stock analysis, then click the card at the top right of the video. Thank you for watching. I'm Osborne Foreman. Stay safe.